Good afternoon, and welcome to the Gatewood Wealth Solutions weekly market commentary broadcast. This is John Gatewood, and with me today is our Chief Investment Officer, Aaron Tuttle.
Hi, John. Glad to be here.
Well, you didn't see me a second ago, but fortunately with technology, we were able to catch me. Hey, well, it's nice to see the economy set to be open here in St. Louis next week, and many clients are experiencing what I will refer to as cabin fever. Yeah, today, I know everybody is. In fact, today we learned of an elderly client whose health has declined significantly since being unable to have typical mobility. Unfortunately, these are the unwanted outcomes of the decisions that have been made with regards to the economic lockdown. But we certainly wish our client and his family the very best as they cope with this crisis. Well, so as mentioned last week, tensions are high between those who are concerned about opening the economy too quickly versus those who must open much faster. Some businesses like Tesla and other local companies are opening their doors against local ordinances. This shows the economic cabin fever effect, leading to anxiety and actions which further divide our nation as we are bombarded with divergent, strong opinions from all sides. Aside from the debate of the COVID course, or the course of the future course of COVID-19, investors are watching for indications of the length and severity of the downturn. Chairman Powell said today that the path ahead is highly uncertain and subject to significant risks. Now, at Gatewood Wealth Solutions, our goal is to present an independent view, which is based upon data analysis and economic theory. So, Aaron, the market continued to inch up last week, but it has slipped 3.5% to 4.5% since Monday. Let's start with your presentation as you explain what we believe is going on at the moment in the market.
Yes, I'm sure our listeners are very familiar with our timeline now, and I just wanted to touch base on that. We continue to track that timeline and have passed the first two benchmarks and are working on that GDP bottoming. One of the other items that is for 1st of June that I'm starting to get a feeling that might be a little bit aggressive is that June 1st restriction-free open across the entire United States. We definitely see states that are going to be there, but there are some different opinions and strong ones that still have to play out. So we're yet to be determined if that's an aggressive open date or not. There is political pressure, doesn't matter what views are to open. So we will continue to track, but let's take a quick look at the daily deaths. That trend line continues to decrease over time. Though we're getting a lot of sporadic data as that comes in, but you can clearly see a declining trend line and that peak and the mid-April timeframe. And when we're looking at that CDC information, this is just based on death certificates. It's not as timely. So we now have 51,495 deaths reported from coronavirus, which is below the numbers that you'll see through the news. But remember, this is delayed numbers. We still anticipate an increase in this number going forward. But we think when looking at that percent of expected deaths, which is that column right next to the highlighter, or two columns next, you can see most of the data looks like it's in for anything before April 11th. And we can see that there is that peak around between April 11th, April 18th. The numbers between 11th, the 4th really didn't change much from last week. Big jump in the numbers on the 18th. So let's move on to second wave. Obviously, these headlines continue to come in the news, and we anticipate that these headlines will remain until fall, because that's really whenever we expect that we'll know whether that second wave has arrived. And we saw some information coming out of Germany, South Korea, where we expected. We have a problem.
a little bit of a problem with the sound.
Okay,
I think we have it fixed.
So however, there were claims that Germany and South Korea were getting a second wave. And we'll look at the data, you see it here. We don't see that. We think that's a premature call at the moment. I'm absolutely going to continue to monitor. But Germany looks like it's just on its trend line. And there is a little bit of a blip in South Korea, but the numbers are still very low. When we look at Sweden, though they're certainly on the high side of data, it really isn't statistically different from the other countries. This means despite the lockdown, the virus fades naturally, and we would suggest this would suggest that when we relieve the lockdown, there would not be a significant second wave. The key word being significant. The virus will likely be with us for some time. It just shouldn't have that exponential growth rate that we saw back in March and early April. GDP forecast, we can see the blue chip consensus on GDP growth continues its decline, though it is flattening. And the recent unemployment report caused the New York nowcast to really drop significantly. That forecast is at negative 31.22%. However, we are beginning to see some signs of activity, or actually the lack thereof activity kind of bottoming. We're starting to see some numbers move. Granted, it's from a low base. So air travel is still down substantially, but it is gaining from its low. We are seeing 40% increase over the last week. Now, once again, that's from a very, very low number, but there does seem to be a pickup in the amount of air travel. Another thing that we're watching is the Google search for coronavirus 19. That's that blue line, and we're noticing they're declining, while restaurant searches are beginning to increase. Now, we have no idea what the motivation is of somebody looking up and searching on Google. It's just data. And really, how many searches would you expect for the coronavirus? At some point, you got to realize everyone knows it's there. There's so much information. It's not a surprise. So why would you continue to search it? But there could be an interpretation here, and simply that more people are beginning to look to what on going out to eat compared to when we go back a couple of months at the start of this crisis. Another interesting headline was a 600% increase in bookings on Carnival Cruise Line. Now, we are sure this is heavily discounted. We've actually heard that it's like $50 for some tickets. And if we look at that stock price on the right, we can see that a 600% increase in bookings didn't move the stock price at all. So what is the cruise line likely trying to do? Well, they're trying to get people to be on a boat. And I'm going to use the word boat, not a ship, because I'm a Marine and all ships are really boats. But you know that they have a hopes that the virus does not arrive, and they're already in dire straits. But if people were to show up in mass and they don't experience that, that's going to reduce fears about taking that cruise. It'll kind of normalize or renormalize the experience. Now, to be sure, there are plenty of individuals who would not take the offer, but there also appear many that will. I think that gets back to what you were saying, John, on just how people are divided. Some are eager to jump on this bargain, while others think it's quite foolish and you couldn't pay them money. Doesn't matter how negative the price would get. Here's the slide for investment theme, and we're going to spend some time on that risk inflation again. I know we covered that last week, but we think this is an area that we really need to focus on, especially since this week we had the release of CPI numbers. As expected, the consumer price index declined in April. There's no surprise there. The overall index declined by 0.8%, and this is the largest monthly decline since December 2008. A 20.6% decline in the gasoline index was really the largest, people say contributor, but I don't think it's a detractor really. And the index for apparel, so clothing, motor vehicle insurance, airline affairs, and lodging away from home all have fell sharply. Once again, no surprise there. Hardly anyone's driving. There's not going to be nearly as many accidents, so insurance payouts are going to be less. You're going to see a drop in that to really keep those policies in place. On the other hand, food indexes rose in April. Now, with the index for food at home, it posted its largest monthly increase since 1974. And some of our clients that did experience the high inflation of the 70s and early 80s know that that was an inflationary environment. So we have not seen an increase in food prices at this magnitude since 1974. But everyone's eating at the, out of the grocery store. There's a little bit of takeout. So that's not shocking. Now, what is interesting is the index for rent, owner's equivalent rent, medical care, household furnishings, and operations all increased as well. Medical care service for the month climbed 5.8%. Where we're looking at that food increase of 2.6 to 4.2, where we're assuming annualized, that would be a 40% increase. So it shows how big that is. But think about how big 5.8% would be for the medical care service. Now, we mentioned that fear is beginning to subside, at least for some people. And we expect the travel-related price indexes to kind of flatten out. We're starting to see some inventory for gasoline move, and that isn't too surprising as some of the economies our state economies are opening. Also, if restaurants were to open with the restrictions and follow those guidelines, and those takeouts that have been kind of the norm and what's helping restaurants go through this are not, don't change. They're kind of not maintained. People want to go out to the restaurant and eat and not do the takeout because of that cabin fever that you were talking about. We expect a substantial price increase for restaurant dining. And the reason is restaurants, they're running on thin margins, and just a few tables is the difference between being in the black or being in the red. So if we're cutting their seating in half because of the 6 feet distancing, then they're going to have to increase those prices. So wouldn't be totally shocked to see in the next month or two some of those prices that have declined kind of stop, flatten out, while some of the others that have been moving up can start moving that CPI up based off that. A fiscal situation. Well, tax receipts are down, and taxes for individuals and corporations were deferred until July. So there's no surprise that we're in what's likely going to be a recession. And then the government said that you didn't have to pay your taxes until a future date. So that's not shocking. When we look on a rolling 12-month basis, receipts were, I love the headline that I saw, just $3.26 trillion. Can I have just a small fraction of that? But that's the lowest since March 2017, and it's down 3% year over year. Now, government spending or outlays exploded by 161%. That's that graph on the right where we see that just big spike. And we missed a $1 trillion mark by just $20 billion. Once again, just $20 billion. Can I just get 1% of that? And this is largely due to the assistance related to the coronavirus outbreak. Now, we have run $1 trillion deficits annually. I want to underline that word, annually, only 4 times in American history. At this point in the pandemic and the recession, we are looking at close to $1 trillion deficits on a monthly basis right now. And this may just be the beginning. A new stimulus bill is already proposed, as well as additional tax relief being proposed. So both of these situations where we have lower tax receipts and we have higher deficit spending because of the increased spending, but also the lack of funding, this may just be getting started, unfortunately. Shape of the recovery, that V shape is still visible, but it's the 3rd week at these kind of in this trading range, or we really are kind of at the same current price. And this is early yesterday, so it doesn't catch the sell-off at the end of the day yesterday or the sell-off today. When we look at those price points that we've been talking about, once again, this is a little bit dated. The S&P has tried to break through that resistance level of 29.50 twice now, and it hasn't done so. Usually tries 3 attempts and then it either breaks through and moves on to the next point, or we have to go back and retest that support. and we actually closed below the next support of 28.50. So there's some pessimism getting priced in the market, but if you look at how fast we've come off that bottom, it's also not that surprising. And if you look at 2020, it's just a little bit further in that chart. You can see that the S&P is still negative for the year. Now, the triple Qs, or really it's the NASDAQ 100, that's not the case. We're still not at a high for an all-time high for the index. But if you look at, go back to January, now this is not at the same scale as the previous chart, so you kind of go midway through the chart, you can see, and that line is indicating that it is positive for the year. So John, we're to the question and answer.
Great.
I'll turn it over to you.
Well, let's just follow along that particular issue, which is that, now the problem that we have today is that in the market, we don't really see true price discovery. In other words, we can't look at companies, look at the fundamentals, create these financial forecasts for discounted cash flows and say, that is what a stock should be worth today. Because of the fact that we have so much money that has been pushed into the system through monetary and fiscal policy. And especially with the magnitude of that going forward, how will other people view or manage money if fundamental analysis really is going to be out the door somewhat? It's not that they can't do some analysis,
right,
but it's nothing to be fundamental because you have this massive factor that has not really been considered in fundamental analysis, right? Because it's an outside factor, if that makes sense.
Yeah, it does make sense, and we're seeing a lot of bearish calls. We're seeing a lot of people say that the market is significantly overvalued, and I can tell you there are people that are making that call that in this industry that are highly respected. They're not the doom and gloom, broken clock that are right every once a decade on these bearish calls. But I think you're right on. One, with interest rates this low, it's really difficult to do fundamental analysis because the margin of error is so huge. If interest rates move, it's going to change that dramatically. And then there's questions on the multiples and they're moving. One of the things that I think is a benefit for our strategy is that we use technical analysis. And that is not necessarily looking at the fundamental analysis. We're aware of the valuations, not to say that we ignore it, but technical analysis is looking at price patterns, which it's not dependent upon accounting rules and ratios and a lot of things that really can be skewed. It will work if fundamental analysis is driving it because it's just trying to extract information on how items are being priced. So we're looking to see what price changes are doing well relative to others, and we're trying to move clients' money there. So we believe the technical analysis works in fundamental analysis regimes, but it'll also allow us to help manage that risk because the margin of error on fundamental analysis, if you can do it well, is pretty good. So even if your models are pretty good assumptions, small changes that you anticipated are going to have major movements and flow.
Well, today, as you mentioned, the House is considering a $3 trillion stimulus package. By the way, I tried to enter $3 trillion on my calculator on my desk, but I couldn't get that many zeros in. So I have to figure out how to work that in the future. But even the Federal Reserve Chairman, Jerome Powell, today in his remarks said that the government may need to spend more to support the economy from the corona-induced contraction, which is interesting because I don't think the corona caused the markets to close. It was
the reaction.
It was the reaction of the governmental institutions. But first of all, what will this mean for the markets? Because we're already talking about massive funds coming in, now the potential for more. And how many more of these bailout packages can there be before we're no longer in a free market economy?
Well, I would say that there's at least some market component to it as long as the markets are open. but we certainly are not following free market principles. So this is modern monetary theory. It's no longer in academics circles talking about hypotheticals. We're trying it. And I think it'll continue on until there's some pain from doing that. I think the pain is going to show up as an inflationary component. We've talked about that and how long it could last. We have deflationary forces with energy, oil, and all the components that we talked about earlier. We have inflationary forces. But if you can print money and you can get money to people and we don't see any pain from that, why wouldn't the government continue to do that? They're worried about elections. They're worried about the current moment. And if there's a stall, I expect to see these stimulus packages. Now, this is back to pushing on a string, though, right? Because it's really hard to pull demand forward and get people doing economic activity if at the same time you're preventing that economic activity. Now, we're beginning to see that slow down and happen within the broader economy. So it's yet to be seen, but I would not be surprised at all to see some infrastructure stimulus bills put in place. The $3 trillion stimulus package is being brought forth by the House with the Democratic majority. $2 trillion seems to be somewhat agreed upon between both sides. The $1 trillion in money to states and more of the city jurisdiction who have really been seeing their revenue cut because of sales tax revenue. That's where the contention seemed to be on the stimulus package.
So let's talk about inflation, because we know, given this, one of the economic theories is that the more dollars you put into the system, if goods and services are exactly the same, you've essentially inflated you've inflated money, right? Mm-hmm. So you have more dollars buying the same number of goods. When we think about inflation as consumers, though, we think about price inflation.
Right.
And so sometimes there's a disconnect between the amount of money going into the system and causing what's called economic inflation and what's then turns into price inflation.
Right.
It's like, as you mentioned last week, you said 2008 really didn't turn into price inflation the way that people thought that it would because of the amount of stimulus at that time. Tell us what you think about this time.
Well, as you mentioned, the previous time, most of that inflation, and we did see inflation, but we saw it in capital markets. So real estate prices moved up, bond prices moved up, stock prices moved up, and people didn't really pull that out of the economy. A lot of it was done in a reverse repo where, unlike today, where the Fed is injecting money into the economy and giving cash and buying some of the bonds from the market. After 2018, they were taking cash on as excess reserves and paying interest. So it was a different scenario. This inflation, so there's inflation in 2008. That's why they did the thing. It showed up in the things that we like to see, right? We want to see our stock prices go up. We want to see our home prices go up. We don't want to see our consumable good prices come up. So it was that roadrunner economy that to reference last week. This one is not targeted at financial assets. It's giving money straight to companies. It's giving money directly to individuals and possibly directly to state, using it for big infrastructure spend, which would have an impact on base materials. You're going to have a lot more concrete. You're going to have a lot more steel. You're going to have a lot more oil to create asphalt. So this one is set up in a way that it's more likely to increase that consumer price index this time and have the inflation show up in consumer goods. It should also show up in financial assets as well, but this may not be some nice increases in financial assets without the increase in consumer goods. We think it's more likely than the previous structure, the way that they dealt with it, to show up in consumer good prices.
Let's switch the topic from the U.S. to international. Can you comment on the recovery of Europe or other international sectors in relation to the expected recovery of the United States?
Yeah, so when we had Bill on for the quarterly call, and he was looking at the international index and the sectors that it was made up there, you could clearly see that the international markets are not heavy technology. And some of the more newer components, they've kind of lacked some of the innovation in the new industries, new sectors that the U.S. has had. They're in older, more value type companies. So they've struggled from that standpoint, that they've lacked some of the things that have done so well over the last few years, and probably will continue to do well. But when we look at the European Union, they have a lot of political issues that just are not present in the U.S. In the U.S., we have individual states. Yes, they are sovereign. Yes, they get to make their own rules. That's why so many of them are opening up at different schedules. But there's also a large national government that really controls a lot of the macro levels. That's not the case in Europe. There's actually a kind of a game of there's conflict right now between the Bundesbank in Germany and the ECB. Germany is very much a hawk when it comes to the creation of money. They don't want inflation. They're just a couple of generations from people that experienced a hyperinflationary environment.
Right, the old pictures of the people with the wheelbarrow putting their dollars into it.
They also have a culture that I think is still reminiscent of Weber's, the capitalism and the Protestant ethic, where there are people that save more and invest more versus some of the more spend-free countries, like say Italy. So we've been talking about Brexit. We know the UK is leaving. That it shows the example of the political unrest, and now we also have this portmanteau called Italy. And there's been a lot of issues that they're trying to figure out within the European Union. How does Italy get bailed out? They want to have an expansionary money supply similar to what the US is doing, but Germany is really dragging their feet because they don't want to bail out Italy for their spendthrift nature. At least that's what how Germany would characterize it.
It sounds like this could really exacerbate the relationship between the countries within the EU, just because you have Germany on the one hand that wants to be hawkish about its financial markets, where Italy, with the debt load that it has, sees that its best way is by inflating the money supply. So you have two contrary views.
Right, and one of
a single monetary system.
Right, one of the German judge that was trying to deal with this says, well, the EU is not the master of the universe, so they are claiming some component of sovereignty and some control over ECB policy. We just don't have that type of problem here in the U.S. So they have much higher hurdles to pass. And that's in addition to the way that their economy has been structured. And then if you look at Japan, the other large player in the international development, demographics are not demographics for growth.
So maybe even though we certainly look to buy when things are low, and Europe and other international markets have been hit hard, the issue is, when is it really the right time?
Right.
And because of all that uncertainty, that's why we remain overweight to the U.S.
Right.
And probably will for some time, unless some of these issues start to get ironed out or more clear.
Right, and our technicals would begin to see that trend change, and it would push us towards those. With the technicals, we'll never buy the bottom. We'll never sell the top. But we will see it early on in either one of those. So we'll get out a little bit after the top. We'll get in a little bit after the bottom, and we think that's a much safer play than trying to. One of the sayings is try to catch a falling knife.
So let's talk about electricity prices, because there's certainly been a lot of focus on oil and gas, that those markets have cratered. But first of all, you have spring that's arrived in the north part of the equator.
Mm-hmm.
And you've had this precipitous decline in electricity prices in the US, Europe, and Asia. In fact, I was reading today that the International Energy Agency expects this to be the biggest decline in electricity consumption since the Great Depression. Can you comment on this?
Well, I can't comment on the details because I haven't had a moment to really get into that index. Are they including gasoline whenever they're doing these energy indexes? Because we know cars are not traveling as much. We know that we can see the problems in the oil market on the demand side. So that certainly wouldn't be surprising to see energy use dropping if it's including that. But I also think it makes sense that we would see a big drop in electricity use. We furloughed a lot of the economy. We're having record unemployment. And you would think that factories and other more industrial capacity use of energy is probably something that is significant, maybe even more than your residential use. And so that's come offline. It wouldn't be surprising to see energy use drop considering where we are in the economy.
Now, here's another interesting fact. So here we are, the government is offering tremendous amounts of financial support through stimulus packages. However, the PPP loan applications have slowed to a trickle, and there's still more than $100 billion of available funding that remains. Can you comment on this?
Well, whenever that first came out, there was a $10,000 free look, right? You can apply and they could deny you, but you still got $10,000 just for applying. It was free money. It was loan forgiveness. There really wasn't that much around it. And they ran out of money pretty quickly. So then they did another offering. Well, one, there was some bad publicity, especially if you were a larger company. Shake Shack gave the money back, if you remember. Some sports organizations also gave money back. So there's some cost there just on the PR if you're taking large amounts. But as we go further into this, you may have signed contracts, but a lot of the items, I'm trying to think of the right word, just the terms of those are getting changed after the fact. And they're talking about fines and penalties and other things. So what I believe is happening is it's no longer just free money where it's running out. There's now some perceived cost, whether that's publicity or a bad PR for taking the money, especially in large amounts if you're a large company. But also, what risks are you entering in if they're beginning to change rules and components after you've received the money? So it's not too surprising to see. And you talk about the unemployment, right? People are struggling to get people back from unemployment. You take the PPP loan, you're supposed to keep these people on, but then your employees are mad because you are trying to hire them back and they're receiving higher unemployment benefits than what you would pay them based on the PPP. So there's just a lot more cost.
Yeah, I've heard people say, well, I mean, you should tell your employee that, you know, you can either have a higher income for a short period of time or you could have a lower income, but now you have a job for a long time. But the reality is that a lot of people will take that lower income now, knowing that there's other job opportunities that will show up. And that's the reality of what we're seeing out there. So
well, I know businesses are businesses. They do look at bottom line, but people are also people, and there's relationships.
Right.
There is a component of not wanting to hurt your employees, and what bad taste do you put in their mouth if you force them to come back and they saw this as a way to get more money. And so it's complex, and like everything, whenever government acts or anything, there's always unintended consequences, right? Whenever we do things and make changes, this is probably not something that'll last long term. So those unintended consequences probably won't get addressed and changed. It's probably that we'll wind this down. And hopefully the economy moves up and we don't need these types of programs.
Yeah, I mean, I know that. So those applications that when people would be accepted, they would sign a loan document, and in there is a paragraph that talks about loan forgiveness, and it states that it will be up to the lending institution to gather whatever that proof is from the employer, but that the money has to be used within 8 weeks of the receipt of the funds. So this is probably going to be a fairly short-term process, because people are going to be going to their banks to find out what they need to do to provide that justification for the use of the loans based upon whatever guidance that the SBA is coming up with now. But it looks like we're out of time. We actually had more questions, but I think that we'll have to save these for another week. But thank you so much, Aaron. You always have amazing, informative, and relevant information for our listeners. I do want to mention that we have clients ask if their families, friends, and acquaintances can listen into the weekly broadcast. And the answer is absolutely yes. If you know of anyone interested in being one of our subscribers, go ahead and let us know. We'll put them on our subscriber list so they have the invitations. You're also free to forward the invitations or post them wherever you wish. So as you know, we at Gatewood Wealth Solutions are on a mission to share our experience with families, helping them become and remain financially self-reliant so they can give purpose to their money. So we want these market commentaries to help not just those who are our clients, but really anyone interested to better understand the market, facts important to one's financial planning decisions, and support of their pursuit of financial self-reliance. So thanks again to our listeners for being here for our broadcast. If you have any questions, please contact your lead advisors or any member of your team. We are here for you. So long for now.